Hey everyone, my name is Eric Jones, better known as the Turf Teacher, and welcome to the course entitled The Accounting Equation. This course is good for one business credit. So I know we've had a lot of three of our business classes. We've talked about one taxes, Social Security taxes, and the other about accounting. But this is the accounting equation. And guys, like I said, I couldn't have a better relationship with the two accountants that are in my life. As you know, my original accountant retired, gave up his CPA license and then went, to work for another CPA, part-time. And he kind of took us with him. Our old CPA still helps us with our books and, preparing our taxes and everything. But then he takes it, to the office of the certified public accountant, to sign our returns. But I love them both to death. They are just super nice guys. They have fun at doing what they're doing, but I trust them. And those are the most important things. You need to trust your accountant. You need to trust your attorney. And these are two people that you don't want to outlive. You know what I'm saying? You don't want to see them actually retire or actually, leave this earth, because once you develop that relationship, it is one that you can't surpass. But let's get started with the accounting equation. We're going to look at our objectives. We're going to define the accounting elements. We're going to construct the accounting equation, so we'll actually see exactly what it is. We will analyze business transactions. We will show the effects of business transactions on the accounting equation and how that actually, gets passed through and recorded. We will prepare and describe the purposes of a simple income statement, statement of owner's equity, and balance sheet. Now, I know this is going to be a question on your quiz, talking about the business entity or business entity concept. But an individual, association, or organization that engages in economic activities and controls specific economic resources is basically a business entity. And we do a whole lecture on business entities. We actually talked about it in the introduction to accounting, LLCs, C Corps, S Corps, partnerships. Those are kind of what we're calling the entities, or it can even be a sole proprietor, to be honest with you. But the business entity's finances are kept separate from the owner's non-business assets and liabilities. This is the business entity concept. And I know that is a quiz question at the end of this lecture. So basically, you do want to keep your personal things separate. That's why we are 100% C Corp. I am all about the C Corporation. And people say, well, there's double taxation. Yes. But there's ways around that. And that's why I trust my accountants. But I want everything separate. I don't want to really be tied to the business. Now, granted, can you personally use some of the business stuff? Yes, you can use a vehicle. You can drive the vehicle. There's certain things like that. My accountant says, as long as you've got somewhere the logo's on it, you can actually drive it and the business actually pay for it. If your spouse is doing banking things for you, running back and forth to the bank, running to Office Depot, getting the supplies you need, and you've got a logo on her Suburban or whatever, a tag or a sticker on the back, you're conducting business. The business can, pay for that. So, but you definitely don't want to pay your mortgage out of your business checkbook. That's one thing that's going to flag it. But this concept, the owner of a business may have business assets and liabilities as well as non-business assets and liabilities. Of course, yes, your personal home, your kids' cars, you may have some toys that you like having at the house or whatever, but you would want to keep everything separate. Your non-business assets and liabilities are not included in the business entity's accounting records. And if the owner invests money or other assets in the business, the investment is now reclassified as a business asset. So yes, personally, you can actually put money into your business. Assets, items owned by a business that will provide future benefits, must be owned, not rented, do not have to be paid off, might still be making payments. So trucks, tractors, here's other examples. Even cash is an asset, merchandise, furniture, fixtures, machinery, buildings, lands, and accounts receivable. And as slow as I am to invoice, yes, my accounts receivable are a big asset to me. I actually finally, with all the rain that we've had here the past 3 days, I've actually sat down and actually got caught up on that, just like I am catching up here on recording these lectures for you guys to take classes. But all of those are considered assets. Accounts receivable, the amount of money owed to the business by its customers as a result of making sales on account or on credit. Simply put, the customers have promised to pay sometime in the future. Now, I've always questioned this, especially in the lawn care, lawn maintenance side of the house. People don't want to pay every week to mow, but yet they go out to eat and they pay before they leave the restaurant. We should be able to charge, for that mowing every time we do it. But most people are so used to actually getting an invoice monthly, and that can cause, cash flow problems. I always, talk about the beginning of the season. We start mowing, sometime mid-March. Yeah, it just depends. It really depends on the weather. But let's say we started March 1st and we started mowing. We mow all March. That could be 4 or 5 times depending on the, number of weeks, especially for some customers. You've got 5 mowings on the books. You send an invoice and they wait 30 days to pay. Well, you've done mowed all of April. So you've mowed it 8 or 9 times before you've got your check on the first invoice. And so that can be a problem. I love the idea of being able to charge, when work is completed. Most other contractors actually do that. So, simply put, again, the customers have promised to pay something in the future. I want them to pay right now. Liabilities, something owed to another business entity. This is what you owe. A probable future outflow of assets as a result of a past transaction or event. Debts or obligations of the business that can be paid with cash, goods, or services. Examples, accounts payable, notes payable. So, yes, you may owe money to Site 1 for irrigation parts or plants that you purchased for a job. Notes payable would be on that new skid steer that you just bought. Accounts payable, an unwritten promise to pay a supplier for assets purchased or services received, referred to as making a purchase on account or on credit. Be careful not to confuse accounts receivable and accounts payable. Ask yourself, are we waiting to receive or are we waiting to pay? A lot of the times it feels like we're paying out more than we're receiving in sometimes, don't it? Notes payable, formal written promises to pay suppliers or lenders specified sums of money at definite future times. And usually it's going to be monthly payments, for a certain amount of years, depending on how large the piece of equipment is. Larger pieces of equipment, I've seen it stretch out 7-8 months. 7-8 years. And, smaller pieces of equipment, maybe 2 or 3 year term loans. Owner's equity, amount by which the business assets exceed the business liabilities. This is also called your net worth, or how much capital that you have to work with. So your assets, how many more assets do you have than liabilities is that net worth. That is called owner's equity. And that's basically, you start the business, you've put stuff in, you're working, you're making money, you don't have that much debt going out. This is called the owner's equity in the business. So if you sold it, usually that is the money that you're going to get. A broader view, assets and the cost of products we buy. Next time you buy something, think of all the assets a company needs to produce that product. I've always said this, You take a landscape contractor or irrigation contractor, look at the stuff that we pull up to the job site with. We're pulling up with, a pretty hefty size dump truck, $85,000. We've got skid steers that are $65,000, $70,000. Excavators, the same. Tractors, a little bit less. And literally, we could pull up to the job site with $250,000, $300,000 worth of equipment to do a job. And yet some of the other trades show up with a van and a toolbox, and they're charging $300 an hour. And we've got customers that balk at, a labor rate of $130, $150 an hour. And yet we're pulling up with sometimes even some job sites, guys, $500,000 worth of equipment. It drives me crazy. But it's our fault. We've created that over the years, and since day one, the green industry existed. But all of these assets that we need to produce a product, we're building that job for the customer. If the product comes from a capital intense industry, one that requires heavy investments in assets, the company must price the product high enough to cover the cost using the assets and replacing them when they wear out. And that's true. And my guys will tear up my employees could tear up an anvil if I let them use it. Like somehow or another, they would break that thing in half. For example, AT&T recently reported that the cost of property, plant, and equipment used for operating purposes came to over $319 billion. Okay, phone company, their property, their plant, equipment used for operating, just to have the services was $319 billion. So they've got to charge us, right? How much that they're going to do, a phone company. So now we're going to look at this accounting equation. Assets equals liabilities plus owner's equity. So assets is liabilities plus owner's equity. Assets, the left side shows the assets, and the liabilities plus owner's equity is the right side, shows where the money came from to buy the assets. So simple as that, guys. We talked about that day one in Accounting 101. I remember that at App State. I was taking some business classes. I was applied mathematics major before deciding I wanted to become a landscape architect and transfer. But I remember hearing this accounting equation for the first time in one of my first business classes that I took as an elective. So example, if a business has total assets of 60,400 and the total liabilities of 5,400, what is the owner's equity? Once the debts are paid, the remaining assets belong to the owner's equity. Assets minus liability is owner's equity. So the basic accounting equation says assets equals liabilities plus owner's equity. We got the 60,400 minus the 5,400 gives us 55,000. Note the accounting equation must always remain in balance. So left side's going to equal that right side. And that's one thing that we need to remember. And as I progressed through that class, I can remember, these smaller problems like this were kind of easy. But as you started looking at a business in its entirety with everything that's owned, just think about that AT&T example, $319 billion. That is a lot of assets and liabilities and everything. And the owner's equity would be, like the shareholders and what it is if they were to be bought out. Business transaction, an economic event that has a direct impact on the business. We've purchased something. We've sold a big job to a customer. That is an economic event. It's a business transaction. Usually requires an exchange with an outside entity. Must be able to measure this exchange in dollars. And all business transactions affect the accounting equation through specific accounts. So, and we're going to take a look at that. So what is an account? It's a separate record used to summarize changes in each asset, liability, and owner's equity of a business. Simple as that. A separate record that summarizes changes in assets, liabilities, and owner's equity. Analyzing business transactions. 3 questions. What happened? Make certain you understand the event that has taken place. Yeah, you've made a big purchase. You've sold a big job. You've sold this big job. You're gonna be purchasing things to actually, do the job. Which accounts are affected? Identify the accounts that are affected. Classify these accounts as assets, liabilities, or owner's equity. And how is the accounting equation determine which accounts have increased or decreased? All right. Yeah. An asset will be accounts receivable. You sold a big job. Well, there's going to be some liabilities to that job because you're going to have to purchase materials and things of that nature. But make certain that accounting equation remains in balance after the transaction has been entered. Now we're going to look at an example. Mitchell's Landscape Company. Let's analyze the effect of transactions on the accounting equation. So we're going to do that. And I don't even know who Mitchell is. It's just a name for this class. Transaction, investment by owner. We got page 1 of 2 talking about this. So Mitchell Williams, the owner, invested $5,000 in the business. Yeah, saved up, left his job. He left you guys. You paid him all winter. He saved up. He was on salary. It rained. Did a little bit of shop work. And then the springtime gets here. He quits you and saved up $5,000 and starts his own business, right? So what happened? Mitch took $5,000 from his personal bank account, deposited in a new account in the business name. So he is in business. Identify the accounts that are affected. Cash and Mitchell Williams Capital. These are the 2 accounts. Let's look at the next page. Classify these accounts as assets, liabilities, or owner's equity. Cash, asset. Mitchell Williams Capital is owner's equity. Determine which accounts have increased or decreased. Cash increased. Mitchell Williams Capital increased. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Assets of $5,000 equals liabilities of 0 plus owner's equity of $5,000. So they do equal, right? 5,000 equals 5,000. He's just taking that 5,000 or taking that 5,000. It's taken. That's not even a word, is it? Took that $5,000, put it in a business checking account. And hopefully he's formed his LLC. Hopefully he has his landscape contractor or irrigation contractor's license. If not, we'll turn him in, right? But assets of $5,000 is equivalent to the owner's equity of $5,000 because there is no liabilities. So transaction A in the accounting equation. Asset, items owned. He had $5,000 in cash that he took out of his personal account. Equals, there are no liabilities. He owes nothing in the business yet. And owner's equity, Mitchell Williams Capital of $5,000. It is his business. He put it in there. It is considered owner's equity. So, transaction B, purchase of an asset for cash. What happened? Mitch bought landscaping equipment for $2,000 cash. I don't know where he got that at unless it's off Facebook Marketplace. But identify the accounts that are affected. Cash is affected and landscaping equipment. Classify these accounts as assets, liabilities, or owner's equity. Cash is an asset. Landscaping equipment is an asset. Even though he took money out, to purchase this equipment, cash is an asset. Your equipment that you're using is an asset. Remember, you can own it or be making payments on it. You have to own it, and payments are okay. But Mitch was able to purchase it outright. So determine which accounts have increased or decreased. Cash decreased, but landscaping equipment increased. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Assets of $5,000 equals liabilities of $0 plus owner's equity of $5,000. Again, assets equals liabilities plus owner's equity. Traded one asset for another. Cash for the new piece of equipment. One asset increased, another decreased, but total assets unchanged. The right-hand side of the equation is not affected. And we will see it in this graph here very, very shortly. Assets, cash plus landscaping equipment. He had the $5,000 minus $2,000 for the piece of equipment that he bought. Leaves him $3,000 in cash, but he still has that $2,000 in landscape equipment assets. So everything is $5,000 still in assets. Liabilities, he owes nothing. Still, I mean, he's operating debt free. Way to go, Mitch. And he still has his capital because of the $5,000 that he had put in to the business, his owner's equity. So 5,000 equals 5,000. So Mitch still doing all right. Now he can go out and charge $25 a yard to mow, right? Purchase of an asset on account. So what happened? Mitch bought landscaping equipment for $1,800 on account. Look at this. He's borrowing it. He's put it on his account. He's rolling in the dough, y'all, getting all these yards to cut. Now he's going to go in there and put some equipment on account. Payments will be made over the next 3 months. No cash is exchanged today. Identify the accounts that are affected. Landscaping equipment, accounts payable. Classify these accounts as assets, liabilities, or owner's equity. Yeah, landscaping is asset, accounts payable is liability. Determine which accounts have increased or decreased. Delivery equipment increased, accounts payable increased. Does the accounting equation balance? Remember, it always has to. Assets equals liabilities plus owner's equity. Assets of $6,800, liabilities of $1,800 plus owner's equity of $5,000, and kaboom, they do balance out. You know, he's purchased that equipment on an account. It was $1,800, so that's $1,800 worth of assets. You know, he has that $3,000 in cash, the $2,000 a piece of equipment that he's purchased debt free, and now he's borrowed money to purchase another piece of equipment for $1,800. So he has assets of $6,800. The liabilities of the $1,800, you know, notes payable, you know, he's got to pay that account. It's not a note. He put it on account. Plus owner's equity of the $5,000 that he originally had in there. $6,800 does equal $1,800 plus $5,000. Asset acquired for promise to pay in the future. Assets increased, but so do liabilities, the promise to pay. Assets increased by $1,800, liabilities increased by $1,800. And again, this graph that we're going to see, this picture, is going to help it out a whole lot more. So cash plus the landscaping equipment, you know, we still have that cash of $3,000. We have the landscaping equipment that we purchased free and clear, $2,000, plus putting another piece of equipment on account that we expect to pay over 3 months, you know, $600 a month, is the $3,800. So add those two together, we have $6,800 in assets. Our liabilities is accounts payable, the $1,800. You know, it is an asset worth $1,800, but it's also a liability of $1,800. We've got to actually pay that off. And then again, the original $5,000 that Mitchell put into his business, you add the $1,800 plus the $5,000, $6,800 equals $6,800. So I know this is basic accounting, guys. You probably already know it. You probably know more about it than I do, but still, it is a good review. And actually, you know, I'm seeing things how they work right here. We have to review this stuff every so often to make it happen. All right, payment on a loan. What happened? Mitch paid the first installment on the spreader of $600. So he went and bought him a spreader. All right. That's an expensive walk behind push spreader, ain't it? No, I'm just kidding. Identify the accounts that are affected. Cash, accounts payable. Classify these accounts as assets, liabilities, or owner's equity. Cash is an asset. Accounts payable is a liability. He made that first payment. Determine which accounts have increased or decreased. Cash decreased because he paid it. Accounts payable decreased? Does the accounting equation balance? Assets equals liabilities plus owner's equity. Assets of $6,200 equals liabilities of $1,200 plus owner's equity of $5,000. Cash asset decreased by $600. Accounts payable liability decreased by $600, and owner's equity was unchanged. So look at that. He made that first statement. Remember, it was $6,800. So he took $600 and paid that first payment because he's going to pay it over 3 months. Well, he had a liability of $1,800, but that decreased. So his assets, decreased because he lost some cash, but his liabilities also decreased, and still has that owner's equity of the $5,000. And we'll see it here in the actual chart. Cash, $3,000. He took $600 away, leaves him with $2,400. Still has that landscaping equipment, of $2,000 that he bought, and the $1,800. Remember, because bought the spreader for $1,800, making the payments over 3 months, $600 each. So the $1,800 plus the $2,000 gives him $3,800. The $2,400 plus the $3,800, he has $6,200. His accounts payable decreased. He made that payment of $600 and brought his accounts payable down to $1,200. He has the $5,000 still in his owner's equity. The $1,200 plus the $5,000 is $6,200. So now you can start seeing where this accounting equation comes into play. Well, I've never really sat down. If you did this for each piece of equipment that you own, you could figure out very, very easily what's in the business. And guys, we get so busy as green industry professionals that we really don't sit down and take the time. The larger companies, yes, because they have systems in place. They have people putting together these numbers for them. But most of us, including myself, we're small operators. And it's hard to produce all this documentation really easy unless we have a spouse that's, in the trenches with us. And that is their niche, knowing exactly how much money is in the business. But we're working all the time. We are working all the time, trying to find our continuing education credit classes. That's why I do these online. I still got to find mine, guys. I can't use my classes teaching for my own. I've got to actually to do that. But I don't mind doing it. I love it. And I love this green industry so much. Revenues. Yes. Let's talk about making some moolah, right? Working for our customers and making that money. The amount of business charges customers for products sold or services performed. And guys, I think across the board, we're all too cheap. Every other trades is charging a premium. And green industry pros, we're a little hesitant. And I see it even with my customers, even mowing. We have a customer we do a ton of mowing for, but they want to pay bottom dollar for that mowing. But yet when we do a landscape job for them, and which is usually about every month, they have something going on. It doesn't matter. It doesn't matter what I charge them. They're like, okay, yeah, no problem. But just knowing the mowing, what it costs to mow, it's basically like we're making a little bit of money off of it, but we could be making more. But we're doing it because we get these other $7,000 and $8,000 landscape jobs each month from them, and then we do a ton of Christmas decorating for them, which the checkbook's wide open for them when it comes to Christmas lights. It's crazy. It's crazy what people's mentality comes to when it involves mowing grass versus other services that they have to hire done. But anyway, these are products or services performed that we're going to charge our customers. Recognized when earned, even if cash has not been received. All right, it's recognized at that point. Increases both assets, cash or accounts receivable, and owner's equity. Examples: install fees, putting in a landscape job or irrigation system. Design fees. We're laying it out. We're drawing it up for them. Maintenance fees. Whether we're cutting the grass or we're shutting down the irrigation system and turning it on for them, twice a year that we see that property. Interest revenue, interest received on bank deposits. I'm not able to keep enough money in my business checking account to draw interest because the faster it comes in, the faster it goes out. And then sales, your actual selling of merchandise. Expenses represent the decrease in assets or increase in liabilities as a result of efforts made to products or to produce revenues. So yes, whatever we do, we're going to have expenses to produce that product or to provide that service. Separate accounts are maintained for each type of expense. Either decreases assets or increases liabilities, but always decreases owner's equity. Examples: rent, salaries, supplies that are consumed, and good old taxes. Nothing is certain in life but death and taxes, right? Accounting period concept. The concept that income determination can be made on a periodic basis, whether it's monthly, quarterly, yearly. Any accounting in a period of 12 months is called a fiscal year. And I do believe that is a quiz question. Any accounting in a period of 12 months is a fiscal year. Most of us in the green industry, we run, January 1st to 12/31. In the military, it was different. At the college, it's different. Government kind of runs on different physical years. There's still 12 months. But, at the college, it's, and the military, I think it was June 30th is the end of the fiscal year. July 1st always starts the new fiscal year. Net income versus net loss. Net income is total revenues are greater than total expenses for the period. Net loss, expenses are greater than total revenue for the period. So net income, we have revenues of $9,000. We had expenses of $5,000. Our net income is $4,000. Well, what about a period here? This would be typically like a February, right? Net loss, revenues, $3,000. You had expenses of $5,000. You kept the guys busy. You didn't want them to lose. You didn't want to lose them. So you cleaned out the shop as many times as you could clean out the shop. And then you had a net loss of $2,000 for that month. But you know what? It's getting ready to kick in. March, April, you're going to be booming. So you kind of actually have to overlook that sometimes. And yet they will leave you for 50 cents an hour more. I actually had a guy leave me for $2 less this year. And I can't understand it. I can't understand it. He's like, well, we was only getting 40 hours during the winter. This guy promised me at least 50. I said, okay, $2 an hour, $2 an hour. So you're going to take that $2 less, at 40, and then you're going to work 50 for less money. The math doesn't make sense, and that's hard to kind of tell these younger guys. But nonetheless, withdrawals. The owner withdrawing cash or other assets from the business for personal use. And it's almost considered like a loan. It reduces owner's equity and assets, and also referred to as drawing. Take a owner's draw. And you can do that. You can do that. My accountant says that. Sometimes you just have to look at that as a draw. Expanded accounting equation. The accounting equation expanded to include revenues, expenses, and withdrawals. Note that revenues increases owner's equity while expenses and drawing decrease owner's equity. And excuse me, look at the graph here, the chart. Remember, we had cash balance of $2,400 in Mitchell's landscape company. His landscaping equipment was $3,800. Remember, he bought the $2,000 outright piece of equipment, and then he had the $1,800 spreader that he put on account. So it gives him $6,200 in assets. With his liabilities, the amounts that's owed, accounts payable is now $1,200 because he's made that $600 payment on the account for the spreader. So all he owes now is $1,200 on it. He has $5,000, in his capital that he put in. And that $1,200 plus the $5,000 is $6,200. Now we can say Mitchell Williams drawing plus revenues minus expenses, the earnings. Owner's investment plus earnings is going to be on the right-hand side, added to the liabilities. But here again, we are still, because we haven't shown anything for earnings yet, the equation is still balanced, $6,200 on each side. So, transaction E, he's out working. He is hustling. He's earned some revenue. So what happened? Mitch received $2,100 cash from clients for landscaping services. Does he need a license? No, not for $2,000, guys. Identify the accounts that are affected. Cash asset was an increase because they paid him cash. Delivery fees, revenue increase. Revenue increases owner's equity. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Cash or asset increased by $2,100. Delivery fees, revenue increased by $2,100. Liabilities were unchanged. Let's look at the graph. Assets. He had that $2,400 in cash. They give him $2,100 that put him at $4,500 cash money. Still has the landscaping equipment, the $2,000 equipment that he purchased, and then the $1,800 that he purchased on account. Counts owed, his liability. He's already made one payment of $600 towards that spreader. He still owes $1,200. Mitchell still has the $5,000 that he pumped into the business. He has not taken any draws, and he had revenues of $2,100. $8,300 equals $8,300. $4,500 plus $3,800 is $8,300. $1,200 plus $5,000 plus $2,100 gives him the $8,300. His accounting equation is balanced. Now, transaction F, he's had to pay some rent, getting him a shop, office, whatever he's at. So what happened? Mitch paid $1,000 for June office rent. Identify the accounts that are affected. Cash, asset, decrease, lost $1,000. Rent expense, increase. Note expenses, decrease owner's equity. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Cash was an asset, decreased by $1,000. Owner's equity decreased by $1,000 for that rent, and liabilities were unchanged. Let's look at it graphically. Cash, $4,500 that he had minus $1,000 for the rent leaves him $3,500 in cash. He still has his equipment, the $2,000 plus the $1,800. So $3,500 plus $3,800 is $7,300. This is equivalent to the $1,200 in his accounts payable. He still owes $1,200 on that spreader. Still has his $5,000 that he put in. No drawings yet. Revenues of $2,100, and then his expense of $1,000. So $3,500 plus $3,800 is $7,300 on the left-hand side for assets equals his liabilities of $1,200 plus $5,000 plus $2,100 minus $1,000. So it gives us $7,200 plus the $2,100 minus the $1,000. And look what we got. $7,300. It's balancing out, ladies and gentlemen. Balance. Transaction G, paid his phone bill. What happened? Mitch paid $100 cash for phone service. I wish mine was that cheap. Identify the accounts that are affected. Cash was an asset, decreased. Phone expense, increase. Note, expenses decrease owner's equity. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Cash asset decreased by 100. Owner's equity decreased by 100. Increase in phone expense. Liabilities were unchanged. Look at it graphically. Cash, that $3,500. Man, he's going to be next thing he's going to do is get a girlfriend or get married and that cash is going to really disappear, right? You're going to see it sink. I'm kidding, ladies. I'm kidding. You're worth your weight in gold. Trust me. So the $100 for that phone bill minus the $3,500 leaves him $3,400. Still has that landscape equipment, $3,400 plus $3,800. Or $3,400 plus the $3,800 leaves him $7,200. Remember, in the last graph, it was $7,300. Still has accounts payable, still owes $1,200 on that spreader. Still has his $5,000 that he pumped into the business. No drawings yet. Revenues of $2,100. And then he had expenses of $1,000 for rent, and then $100 for the phone. The $2,100 minus the $1,100 leaves him $1,000 there from his revenues. But $1,200 plus the $5,000 plus the $1,000 gives him $7,200. This accounting equation is balanced. Okay. Landscape revenues. This is transaction H. Landscape revenues earned on the account. What happened? Mitch performed landscaping services in the amount of $2,400. Cash is not received at this time. Now he's experiencing what it's like to be a landscaper. Probably worked for a builder, right? Accounts receivable is increased for the amount owed to Mitch. Identify the accounts that are affected. Accounts receivable, asset increase, landscaping fees, revenues increase. Note, revenues increase owner's equity. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Accounts receivable, the asset increased by $2,400. Owner's equity increased by $2,400. An increase in landscaping fees. Liabilities were unchanged. Look at it graphically. Revenue is recognized when it is earned, even though cash is not received. $3,400 in cash. Accounts receivable gives him $2,400 plus his equipment. Assets, items owned. He owns $9,600. Liabilities still has that notes or accounts payable of $1,200. His capital of $5,000. Revenues of $2,100 plus $4,500. Those expenses of $1,100. Add the $1,200 plus the $5,000 plus the $4,500. Get what I'm saying? $9,600. Good stuff here. The accounting equation balances. As you can see, this, like your chart of accounts and everything, like this can get really, really complicated, especially with, businesses doing several $1 million worth of business and owning, how many millions of dollars worth of equipment. You need somebody full-time into this, right? And I know landscape companies, I even know other trades people that have a CPA on staff, that actually have an attorney, that's, experienced in taxes, that are actually keeping up with this information for them. All right. Transaction I, purchase of supplies. What happened? Mitch purchased supplies for $80 cash. Supplies should last for several months. Supplies should be recorded as an asset since they provide future benefits. Identify the accounts that are affected. Supplies, asset increase, cash asset decrease. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Supplies are an asset increased by 80. Cash asset decreased by 80. Liabilities and owner's equity were unchanged. Let's look at it graphically. Supplies is a prepaid expense account since supplies will be charged off the expenses when they are consumed. So he had cash, $3,400 minus $80 to get the supplies. Leaves him with $3,320. Still has that accounts receivable. The man he may never gets, depending on which builder it is, of $2,400. He has supplies in 80 because they become actual assets. Even though he lost cash, supplies were gained, and then still has the $3,800. We are still at $9,600 in assets. Accounts payable, $1,200 for liabilities. Still has his capital revenues of $4,500, and then expenses of $1,100. 9,600 equals 9,600. So the cash decreased, but supplies were gained. Transaction J, purchase of supplies. What happened? Mitch received $1,900 in cash for landscaping services performed for customers earlier in the month. Owner's equity is not affected by this transaction. Revenue was recognized when earned. Remember? Maybe they're holding that retainer. It decreased, all right? Identify the accounts that are affected. Accounts receivable, asset, decrease. Cash asset, increase. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Accounts receivable, asset, decreased by $1,900. Cash asset increased by $1,900. Liabilities and owner's equity were unchanged. Let's look at the picture. Assets, the $3,320 plus the $1,900 gives him now $5,220 in cash. His accounts receivable decreased, so they're holding back $500. Maybe he needed a draw on the job. Plus his supplies of $80, plus his equipment $3,800, totals up to be $9,600. Nothing really changed on the other side, the owner's equity, right? Accounts payable remained the same, $1,200. His capital of $5,000, revenues of $4,500, and his expenses of $1,100. Totals $9,600. Transaction K, purchase of an asset on account, making a partial payment. What happened? Mitch bought a spreader for $1,000, paying $300 cash and agreeing to pay the rest over 4 months. Note transaction affects 3 accounts. Identify the accounts that are effective. What's he need another spreader for? He ain't even got but just 2 employees. He ain't got but 1 employee himself. Landscaping equipment, asset increased, cash asset decreased, accounts payable liability increased. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Cash decreased by $300. Landscaping equipment increased by $1,000. Accounts payable liability increased by $700. So yes, we can already see that it's going to balance. Owner's equity is unchanged. Let's look at it on the picture. Cash, he gave $300 like a down payment for it. Leaves him with $4,920. Accounts receivable, he still has that $500, probably in retainer, plus the $80 in supplies, plus the original $3,800 that he had in equipment. But now he has a new spreader that's worth $1,000. So that gives him $4,800. Add the $4,920 plus $500 plus $80 plus $4,800 gives you $10,300. His liabilities, accounts payable, remember, increased. He had that $1,200 for that first spreader. The second spreader that he bought for $1,000, but he gave $300 for, still owes $700 over on it. So he owes $1,900 now. Still has his capital of $5,000, revenues of $4,500 minus the $1,100 in expensive. Assets is equivalent to liabilities plus owner's equity, $10,300. The accounting equation balances. All right, let's look at transaction L, payment of insurance premium. Whew, I'm going to see that whole cash side deplete, right? Especially if he's using Farm Bureau. I love my Farm Bureau, but they love Farm Bureau themselves, right? What happened? Mitch paid $700 for an insurance policy that lasts 7 months. Note, since the policy provides future benefits, should be recorded as an asset. Me paying Farm Bureau is an asset. Identify the accounts that are affected. Prepaid insurance, asset, increase. Cash asset, decrease. Does the accounting equation balance? Asset equals liabilities plus owner's equity. Your cash decreased by $700. Your prepaid insurance, which is an asset, increased by $700. Your liabilities and owner's equity were not changed. Let's look at it on paper. The pretty picture. Both supplies and insurance are recorded as assets because they will provide benefits for several months. I don't see how $80 worth of supplies is going to last. I mean, I guess that's several pins. But the insurance, He took $700 out of his cash. The 4920 minus 700 leaves him 4,220 in cash. Accounts receivable, he still owed $500. He has his supplies of 80. He has the insurance of 700, and then the landscaping equipment of 4,800. Add all those together, you got 10,300. Basically, it's staying the same, right? Because the cash was decreased, but his insurance was added. It is considered an asset. Look at the right-hand side of the equation. Accounts payable, 1,900. The 1,200 plus the 700. Still has his capital, original investment of $5,000. Revenues of $4,500 and expenses of $1,100. 10,300 equals 10,300. The accounting equation is balanced. All right. Transaction M, payment of wages. What happened? Mitch paid $1,650 in wages to his employees. That's why he needed that second spreader now, right? Yes. Identify the accounts that are affected. Cash, decreased. Wage, increase. Note, expenses, again, decrease owner's equity. Does the accounting equation balance? Assets equals liabilities plus owner's equity. Cash asset decreased by $1,650. Wage expense increased by $1,650, which decreases owner's equity, and liabilities are unchanged. Let's look at it graphically. As with other expenses, cash is reduced and owner's equity is reduced by increasing an expense. Cash, the 4,220 minus 1,650 leaves him with 2,570. He can make payroll next week. Accounts receivable still $500. Supplies 80. Prepaid insurance 700. Equipment that he still has 4,800. So 8,650. Accounts payable remains at 1,900. Still has his original investment of 5,000. Revenues of 4,500. Expenses 1,100 plus the 1,650, which is a negative, but is a wage expense. You add the 1,900 plus the 5,000 plus the 4,500 minus 2,750 gives you 8,650. Your assets is equal to your liabilities plus owner's equity. It is balanced. Transaction in. Landscaping for cash and on account. What happened? Landscaping fees of 3,500 were made, 900 in cash, 2,600 on account. Identify the accounts that are affected. I don't think I would go this route if I was him. The cash increased, accounts receivable increase, landscaping fees, revenues increase owner's equity. Does the equation balance? Again, assets equals liabilities plus owner's equity. Cash increases by $900. Accounts receivable increased by $2,600. Landscaping fees or his revenue from this job increased by $3,500, which increased his owner's equity. No liabilities were affected. Let's look at it graphically. Recording these revenue impacts three accounts while the equation remains in balance. 2,570 plus the 900 that he got in cash gives him 3,470 in cash now. His accounts receivable, that original $500 plus the 2,600 now that's still owed to him is 3,100. Still has his supplies of $80. Still has his insurance of $700 and his landscaping equipment of 4,800. Add the 3,470 plus 3,100 plus 80 plus 700 plus 4,800. Gives you the 12,150. Liabilities still remain 1,900 plus his owner's equity, 5,000 in original capital. Revenues of 4,500 plus the 3,500 gives him 8,000. Still had those expenses of 2,750. So 1,900 plus 5,000 plus 8,000 minus 2,750 is equivalent to $12,150. The equation is balanced. Transaction note, withdrawal of cash from business. What happened? Mitch took $3,000 out of the business for personal expenses. Uh-oh, I told you. He got him a girlfriend. Identify the accounts that are affected. Cash, decrease. Drawing account. You can take a draw. And guys, that's legal. Like my accountant talks about that all the time. Eric, we'll just set that up as a draw. It was an increase to owner's equity. Withdrawals decrease it. My bust. Withdrawals decrease the owner's equity. The drawing account increased. But does the accounting equation balance? Assets equals liabilities plus owner's equity. Cash decreased by $3,000. I don't know. Did he have that in the bank? He is not going to be able to make payroll next week. Cash decreased by $3,000. Drawing account increased by $3,000. Liabilities are unchanged. Let's look at it graphically. Withdrawals by the owner are reported in the drawing account. Withdrawals are the opposite of investments by the owner. Just like expenses, the drawing account will increase in this situation, but it does cause a decrease in the owner's equity. Still had the cash removed, $3,000, leaves him with $470. Accounts receivable of $3,100, plus supplies of $80, plus his prepaid insurance of $700, plus his equipment $4,800, $9,150 in assets. Liabilities, $1,900 still owed on accounts. His original $5,000 in capital. His drawing of $3,000 plus the revenues of $8,000 minus the expenses of $2,750, so $1,900 plus $5,000 minus $3,000 plus $8,000 minus $2,750 is $9,150. The accounting equation is balanced. Assets does equal liabilities plus the owner's equity. Financial statements. 3 commonly prepared financial statements is your income statement, statement of owner's equity, and balance sheet. And a lot of you may already be general contractors. You know that you have to produce this to actually renew that license if you have an intermediate or unlimited license. Financial statement headings, the name of the company, the title of the statement, the time period covered, or the date of the statement. Example would be Mitchell's Landscaping income statement for month ending June 30th, 2025. I'm going to change that to July 31st because that's when our license expires, right? Guidelines for preparing financial statements. Financial statements are prepared primarily for users not associated with the company following a standard format. Kind of talked about that in the other accounting class. Single rules, underlines, indicate that the numbers above the line have been added or subtracted. Double rules, double underlines, indicate a total. Dollar signs are used at the top of columns and for the first amount entered in a column beneath a ruling. On the income statement, some companies list expenses from highest to lowest dollar amount, with miscellaneous expenses listed last. On the balance sheet, assets are listed from most liquid to least liquid, and liquidity measures the ease in which the asset will be converted to cash. Liabilities are listed from most current to least current. Three basic principles in the accounting process. Input. Business transactions provide the necessary input. It is what you are doing. Processing. Recognizing the effect of these transactions on the assets, liabilities, owner's equity, revenues, and expenses of a business is the processing function. And then with your output, the financial statements are the output that you're going to have to show your banker, licensing board, bond company, or whatever it is to conduct or maintain conducting your business. So in conclusion, we defined the accounting elements. We constructed the accounting equation. We used Mitchell's Landscaping as an example. We analyzed business transactions. We showed the effects of business transactions on the accounting equation. And then we prepared and described the purposes of a simple income statement, statement of owner's equity, and balance sheet. And ladies and gentlemen, that concludes this course, the accounting equation. Glad you were able to stick through it, and I will see you in the next lecture.